What is portfolio rebalancing and how you can benefit from it? Hi everyone, my name is Phan and I'm an independent certified financial planner practitioner. One of the reasons I do educational video because I want people to have access to high quality financial knowledge and insight. Today, I'm going to talk about portfolio rebalancing. So what is portfolio rebalancing? Portfolio rebalancing is returning your current investment allocation back to its original target investment allocation, going back into balance. What does that mean? For example, let's say you start with a baseline of a 6% stocks and 4% bonds portfolio a couple years ago. Right now, your portfolio is 70% stocks and 30% bonds because of the appreciations in stocks. To get back to the baseline, you do portfolio rebalancing by selling some stocks and then using that money to buy some bonds to get back to 6% stocks and 4% bonds. Why do you need to rebalance your portfolio? There are two reasons why you may need to rebalance a portfolio. One, managing risk. The stock market fluctuates. Some investments do better or worse than others. Stocks are riskier than bonds because stocks have a higher risk of loss, but also generate higher return compared to bonds in the long run. Therefore, stocks tend to increase in percentage in your portfolio over time. For example, based on your risk tolerance, you should be in a 6% stocks and 4% bonds portfolio. If you start out with a 60% stocks and 4% bonds portfolio, and later your portfolio is 70% stocks and 30% bonds due to market fluctuation, you are exposed to unwanted risks. Rebalancing the portfolio helps keep the risk level of the portfolio consistent with your risk tolerance. 2. There are also studies that shows rebalancing can increase total return because you are selling what is high than buying what is low, like the methodology of buy low and sell high. When should you rebalance? There are 3 strategies. 1. Pick a date. It could be in April when you are doing your taxes or in December to take advantage of tax loss harvesting at the end of the year. Tax loss harvesting is realizing a loss and using that loss to offset a realized gain, or realizing the loss so you can minimize your tax burden on your tax return while maintaining your target investment allocation. Also, on a side note, with technology nowadays, tax loss harvesting can be done daily and not just at the end of the year. Or 2, you can rebalance when it is outside of the tolerance band. For example, you pick a tolerance band of 5%, which means when an investment shifts plus or minus 5%, it is time to rebalance. Going back to our example of 60% stocks and 4% bonds portfolio. When stocks are more than 65% or less than 55% of the portfolio, it is time to rebalance. When bonds are more than 45% or less than 35% of the portfolio, it is time to rebalance. That is just one way to calculate tolerance band upper and lower limits. Another way is a percentage of a percentage position. For example, a 5% tolerance band is 5% of the percentage position, plus a minus 5% tolerance band of 6% stocks position is 63% and 57%. Plus a minus 5% tolerance band of 40% bonds is 42% and 38%. A rebalancing will only be triggered once the position actually crosses the higher or lower limits. 2 things to keep in mind. 1. In regards to picking the tolerance band to rebalance, it is really up to the investor. Instead of a 5% tolerance band, they may want a 10% tolerance band because they want to ride the momentum. Please be aware that you are taking on more risk the wider the tolerance band is. 2. The different asset classes can have different tolerance band because of their volatility. For example, I went on Yahoo Finance to compare the biggest 500 companies in the United States, also known as the S&P 500, and compare it to the bond fund for the last 10 years. The S&P is the blue line and the bond fund is the red line. As you can see, the blue line is more volatile than the red line. The red line should have a lower tolerance band than the blue line. If the red line has a high tolerance band, it may not get rebalanced frequently enough. If the blue line has a low tolerance band, it will constantly need to get rebalanced. Or 3, you can use a combination of the two strategy. Pick a date and use tolerance band. A good client of mine asked me, "What do most people do?" I told her, most people, but not all, don't rebalance their portfolio because they don't know about rebalancing and how to do it in a cost and tax efficient manner. And that is one of the reasons this educational video is so important. Now that you understand a little more about what is rebalancing, let's look about the actual rebalancing process. There are 4 steps to the rebalancing process. 1. Determine your target asset allocation for your portfolio based on your risk tolerance and objective. 2. Define when you need to rebalance and have a disciplined approach. 3. Define your portfolio current asset allocation. And 4. If you need to, determine what you need to buy and sell to get to your target asset allocation. What are the ways to rebalance? There are many ways to do that. You can use one or any combination of these strategies to rebalance your portfolio. You can, option A, use current money, selling highs and buying lows. Selling appreciated investment, then using that money to buy other investment to align with your target asset allocation. Option B, use new money to buy underweighted asset classes. Option C, use dividends and capital gains distribution to buy underweighted asset classes. Option D, withdraw from overweighted asset classes. Let's say you are a retiree and you need to withdraw your portfolio to live. You can withdraw money from overweighted asset classes to rebalance the portfolio. Reminder, rebalancing can get a little tricky when you have multiple accounts, like taxable account and tax advantage accounts. You have to run the numbers to see where to buy and sell. Maybe keep the taxable account the way they are and only rebalance the tax advantage accounts, because with taxable account, realized gains are taxable. Due to market movement, you can be exposed to more risk than you originally intended if you don't rebalance the portfolio. Although there are a couple of ways to rebalance a portfolio, the most important thing is to pick a method and stick to it. When your goals, time horizon, and risk tolerance have changed, chances are your asset mix in your portfolio will have changed too. So before you rebalance the portfolio, be sure to check to see if your goals, time horizon, and risk tolerance have not changed, because if it has, then you may actually have a new target asset allocation. Portfolio rebalancing could protect you from trading based on emotion. Rebalancing is a simple concept, but sometimes it can be complicated in practice because of the investor's unique circumstances, type of accounts involved, trade fees, and taxes if applicable. The takeaway is that there are no one way or one ultimate strategy for rebalancing your portfolio, just like no one can predict the stock market. We can only learn from historical data and make our best and educated judgment as an industry to determine when to rebalance. We don't have to have a perfect plan, just have a rebalancing strategy and stick to it. I hope the information was helpful and practical. Until next time, this is Tan, your trusted advisor.